In this video, I'm going to talk through 5 common mistakes that property investors when using Xero. Okay, the first one then is mixing business and personal expenses. So this is quite a common mistake I see. Rather than having a separate business account, property investors will use a personal account and they'll basically combine their business and their personal expenses in that. It just means that when you come in to do your reconciliations, it's going to be quite confusing because you're going to have on the one hand personal and also business expenses. So it's going to make your life a lot easier if you separate these, and the easy way to do that is just to have a completely separate bank account for your business expenses. That's going to prevent this this issue from occurring. So make sure firstly then you separate business from pleasure by having a separate bespoke business account for all of your property transactions. Okay, the second mistake then is not keeping up with your bank reconciliations. So particularly as you get to over the time, as you grow a larger portfolio, you can have a significant number of transactions going through your Xero account on a regular basis. It's really important to stay on top of these, because if you don't, then you're going to soon find that you've fallen behind and you can have a significant build-up of reconciliations. And to be honest, the longer you put it off, the worse it's going to be, because at some point you're going to have to go back to it and action all those reconciliations. So it's really important to make sure you stay on top of them and avoid falling behind. There's basically, from my experience, there's 2 different kinds of people. The first one is somebody who is quite happy to do their own bank reconciliations and keep on top of things and never has to be reminded. And the second type of person just cannot keep on top of things when it comes to Xero bank reconciliations. If you fall into that second category, then you're probably best, to be honest, finding a bookkeeper or someone to help you out with it, because it's going to become it's going to continue to be a problem, and it's going to get worse as your portfolio grows and you've got more and more transactions. So if something you don't enjoy, make sure you get some help with a bookkeeper. Okay, we come on to then the third common mistake that I see property investors making in Xero, and this is not using tracking categories. Okay, so tracking categories, I've got a really good video which I will share in the notes, which basically will give you information on how you do this. But basically it's a tool in Xero which enables you to separate each of your properties using tracking categories. Basically it means that whenever any expense or piece of income comes in, you can tag it to a particular property. That's really important, so you can analyse your portfolio and see which properties are performing well and which ones not so well. So if you're a serious property investor, it's a really key way to track your business as you go forward. So make sure you use tracking categories. They're really easy to set up, and I'll show a video where you can do this so you can get started. Okay, come on to then number 4 then, which is not making year-end adjustments. So it depends how your setup is, but in the case of, say, a Xero property investor who has an accountant, you'll be going through and keeping up to date with your expenses and income in Xero. At the end of the year, you'll be able to share that information with your accountant. This could either be by their tax software linking directly with your Xero account, or perhaps you send them a trial balance. There's quite a few cases where I hear of where, despite having this really organised Xero account which is showing all your income and expenses and it's been diligently tracked by yourself, you're still sending your accountant information in the form of bank statements. So it could be comma separated values bank statements. This makes absolutely no sense. If you're using Xero, then they shouldn't be then requesting information off you via bank statement, because that opens yourself up for human error, because it's going to mean someone has to manually put something in to Xero or into their accounting software that they use. So it's really important to make sure that firstly your accountant has access to your Xero account, or is at the very least receiving a trial balance from you from Xero, so they can use that as a starting point to produce your accounts, rather than relying on bank statements, which is very old-fashioned and, as mentioned, open to human error. But what you'll find is you'll have your information in Xero, which is great. You're going to share it somehow, hopefully via trial balance or directly into your account software. But then once they work out your accounts, they're going to do things like work out how much tax you owe. It's really important then that information, once it's been put into your accounts, it's not necessarily going to show in Xero, so it's making sure your accountant shares that information with you so you can then update Xero. So a common way to do this is you can use something called journals in Xero. You get the information as to how much tax you need to pay, and then you're going to have to do a journal transaction in Xero, which is going to mean that Xero then is aligned to your accounts. If the two are showing different sets of information, that's going to cause you issues down the line because they're not going to, the numbers aren't going to marry up. So yeah, make sure you speak to your accountant after they've done your accounts to make sure that your Xero is going to match up with what is in the accounts. Okay, we come on then to the fifth common mistake that people, property investors, make in Xero, and that is miscategorization of expenses. Okay, so in some cases it's quite an easy fix. Maybe you accidentally you accidentally record something as a certain type of expense. Say for example, you record something as insurance when actually it was maintenance. Mistakes can happen, and actually there's a really good way to fix it. As a tool called Find and Recode. It's particularly useful when you've made like a series of errors. You've thought you were using the right accounting code, and it turns out at the end of the year you weren't, and maybe you have like 20 different expenses which have all gone to the wrong accounting code. That's really easy to fix. You use something called Find and Recode. I will show a video. I'm not sure I've recorded one yet. I'll record a video on that to show you how you can do it. It's a really easy way to fix a large number of mistakes, but it can be more of an issue when you have like a significant error in terms of miscategorization. So the key one would be getting mixed up between capital and revenue expenses. So just a quick reminder then, revenue expenses includes things like most property maintenance, repairs, etc. And basically revenue expenses are deductible from your income, so it's a business expense. That's counter to capital expenses. So capital expenses are major improvements or improvements to typically things like construction work. So for example, a good example of a capital expense could be making a significant improvement to a property, such as installing a brand new ensuite bathroom in a bedroom that wasn't there before. So it's not a like-for-like replacement. You're actually improving the value of the property by creating a new bathroom in a bedroom that wasn't previously there. So maybe some of these expenses related to the decoration, etc., could be classed as revenue, but there's definitely going to be a capital expense part of this, and so it's really important in Xero that the two are treated correctly. So if it's a revenue expense, it's going to result in a deduction against your profits. If it's a capital expense, it should then go on the balance sheet and increase the value of the property. So it's a difference of the revenue expense going on the profit and loss as an expense, and the capital expense going in the balance sheet as increasing the value of the property. So you can see if you get these two wrong, then the property values could be wrong, and you might overinflate or underinflate your revenue expenses, and so it's going to result in a mistake when you come to do your accounts at the end of the year, assuming your accountant doesn't pick it up. So it's really important that you definitely learn the difference between revenue and capital expenses, and you make sure you categorize them correctly in your Xero account. And if you're unsure, it's probably something you should seek advice from your accountant to make sure you capture them correctly. So just to summarise then, we've talked through 5 common mistakes that property investors make in Xero. The first one being mixing personal expenses with business expenses. So make sure you keep a separate business bank account just to make things really simple to avoid mixing business with pleasure. Make sure you stay on top of your bank reconciliations. The longer you leave it, the harder it's going to be. It's going to mean they build up and build up. It's going to be really stressful when you come to do it. If you're someone that ends up doing it at the end of the year, it can be really boring just to have to go through hundreds and hundreds of transactions at the same time, and it's more likely you're going to make a mistake if you do that. The next one then was not using tracking categories. This is a really useful tool in Xero. It's going to enable you to then separate the income and expenses from your different properties, so you can see what the performance is like on your different properties and make informed business decisions. Number 4 was not conducting end of year adjustments, so making sure things like corporation tax were included in Xero if they've been put into your accounts. So make sure you speak to your accountant at the year end after your accounts are submitted to ask them if there's any transactions that need to be then copied across from the accounts into Xero. To be honest, ideally your accountant will be using Xero and will be linked into your account, and so this won't be an issue, but I know a lot of property investors whose accountants still don't use Xero, and that's where you have issues. Okay, and the final one, which can result in significant errors, is miscategorizing expenses. And I talked about the use of find and recode as a way to kind of make those adjustments after you've made mistakes, assuming you identify the mistake. But yeah, a big one which can cause serious issues, which result in either misstating or understating your accounts, is miscategorizing capital and revenue expenses. So make sure you learn the difference. Revenue expenses you can deduct from your rental profits. Capital expenses increase the value of your property, so they're completely different treatment. Anyway, I hope you found this video useful. If so, please remember to like and subscribe for further content.